Owning rental properties can be a lucrative business, but only if managed correctly. A ton of time, money, and effort goes into investing in rental properties, but if you're a new investor, it can be challenging to recognize the red flags. In today's video, we discuss the most common investor mistakes and how to steer clear of them. Not every property is going to work out. You may find an excellent rental home online that turns out to be a fail when you see it in person. Before you get too far into the investment process, look for these common red flags so you don't make a huge mistake. Number 1, cheaper isn't always better. Just because you find a cheap rental home to buy doesn't mean you should go through with it. Unless you're looking for a fix and flip property, steer clear of listings that are too good to be true and beware of homes that are sold as is. Major renovations and repairs cost a lot of money, so don't get too involved in a cheap real estate listing unless you're ready to spend the time and money fixing up a damaged property. Interested in learning more about what's important to investors, property managers, and tenants? Well, hey there, it's Alyssa from Bay Property Management Group. Just a quick pause in the video as a reminder to hit that subscribe button so you never miss out on the latest videos with new content uploaded weekly. We appreciate your support, and now back to the video. Number 2, avoid elusive sellers. If you think a seller is hiding information from you or being dishonest, they probably are. For example, if your seller can't answer questions about lot size, boundary lines, zoning restrictions, and square footage, that's a major red flag. Not only is this information crucial for someone looking to buy a rental property, but it's information that everyone should have access to. It's important to do business with people you trust. However, even if you have confidence in a seller, remember to do your due diligence before getting wrapped up in a sale. Number 3, ensure your numbers add up. Investors must run the numbers before any potential investment. Before you commit the time and expense to make an offer, make sure the property is worth it in the first place. Don't rely solely on a seller's spreadsheets showing significant returns. You have to do the work yourself. And be careful not to become overly involved in a rental that won't give you the returns that you want. Number 4, avoid investing in declining areas. If the neighborhood looks like it needs work overall, it's going to be noticeable to potential renters. Pay attention to the condition of area streets, sidewalks, and other properties. If they are all in need of repair, it's going to be hard to find renters. Data such as school ratings and crime statistics can tell you a lot about an area. One of the biggest investor mistakes is buying property without analyzing the crime rate and potential risks. Although it may be cheaper, purchasing a property in a high crime area puts your investment and tenants at risk. And number 5, property size matters. Houses that are too large or too tiny don't make the best rental investments. The larger the home, the higher the maintenance costs will be, and renters with tight budgets aren't going to want to pay high prices for a large rental. Along with that, small rentals could scare away families looking to expand or renters looking for roommates. Although you can always add on rooms or make renovations, you have to consider the cost it takes to do so. If you successfully avoided the red flags of a property sale, that's awesome. But that doesn't mean the hard work is over. Here are some of the biggest mistakes to avoid as you navigate your new investment property. Number 1, underestimating costs. If you're investing in rental properties, you're likely looking for a decent return on your investment. If you underestimate the costs it takes to create and maintain a rental company, it will not end well. Not only do you need to consider the initial costs of purchasing a property, but the cost of maintaining it over the years, including taxes, mortgage interest, repairs, maintenance, and utility costs. Number 2, not accounting for vacancies. You never know when a tenant is going to leave, and every investor must account for vacancies in their rental properties. If you expect your rental to be occupied at all times, it could cause you to underestimate business costs, leaving you in a tight financial situation. To avoid putting yourself in a tough spot, it's crucial to save enough money to cover property expenses for up to 3 months. Although it's the worst case scenario, you don't want to rush the process of finding a new tenant just to find out they aren't reliable. And number 3, neglecting to inspect. If you're thinking about purchasing any type of real estate, you should be thinking about an inspection. This ensures the property is compliant with building codes, fire codes, and safety standards, which is an important part of the decision process before buying. If there are any concerns, you should complete repairs before allowing tenant occupancy. Landlords and property managers should also complete a move-in and move-out inspection between tenants, which can identify any damage, issues, or concerns within your rental property. To avoid some of the most significant investor mistakes, remember to always prioritize maintenance, don't forget due diligence, and work with qualified professionals. For expert insights on a variety of rental industry topics, check back in for weekly video uploads, and don't forget to hit the notification bell for exclusive updates. Thanks for watching, commenting, and subscribing. We will see you in the next video.